Before we start the video, I'd just like to introduce our new revision package. For $10, you get 7 days access to our entire ACCA Performance Management exam course. For more details, please check out the links in the description below. And now, on to our video. Okay, so in the ACCA Performance Management exam, pricing decisions is a popular chapter to be tested. And the most common type of question that gets asked in the section C part of the exam from this chapter has two parts usually. One part will be analytical based on market scanning and penetration pricing. The second part will be based on calculation. What calculation? Specifically the profit maximization calculation. Now this calculation is quite straightforward. It has certain steps that you need to follow. If you follow these steps, you shouldn't have any trouble with it, okay? So let's go through an example to demonstrate how this calculation works. So a company is planning on launching a new product. The variable cost for the product to produce a unit is $10. At a price of $15, the demand is expected to be 3,000 units. At a price of $14, it is expected to be 3,200 units. The total fixed cost is expected to be $12,000. Determine the optimum production plan and the maximum profit that can be earned. So optimum production plan and maximum profit go hand in hand. And when you see maximum profit, you immediately should know it's a profit maximization calculation, especially when they start talking about demand, okay? So the first step to this calculation is to find B of the demand curve, because the first few steps we're going to be finding the equation for the demand curve, which we covered earlier in the chapter. Okay, so for B, we said the formula is change in price over change in quantity demanded. So in this case, the price is initially $15 and it can fall to $14, and over quantity demanded, if the price is 15, demand is 3,000, and if it's 14, it's 3,200. So we end up with 1 over negative 200, or in other words, is equal to negative 0.005. So that's the value of B. Second step, again, these steps are the same for the demand curve. Based on B, we need to find the value of A, right? And we can use any combination of P and Q. So we can use 15 and 3,000 or 14 and 3,200. So we so far have the equation P is equal to A minus 0.005 Q. Now, we will substitute 15 for P and 3,000 for Q. So this becomes 15 is equal to A minus 0.005 into 3,000, right? So, which is equal to A minus 0.005 into 3,000, or 3,000 over 200 will give us 15. So if we take 15 to that side, we'll end up with A is equal to 15 plus 15, which gives us 30. So P is equal to 30 minus 0.005 Q. That's our demand curve, and those are our first two steps of this profit maximization calculation. Now, based on the demand curve, we can immediately get the equation for marginal revenue, which, if you remember, is A minus 2BQ. So A is 30 and B is minus 0.005 Q. So it becomes minus 0.01 because we multiply it by 2 and this Q, okay? Third step, we set this equal to MC, because remember, profit is maximized where MR, marginal revenue, is equal to MC, marginal cost. So if MR is equal to 30 minus 0.01 Q and MC, which is the variable cost, is equal to $10, we get this equation. And based on this equation, we can find the value of Q, which is our next step. Find the quantity where profit is maximized, which is basically Q in this equation. So we'll solve this equation. We'll take 30 to this side. We end up with minus 0.01 Q is equal to 10 minus 30, which is equal to minus 20. So Q is equal to minus 20 over minus 0.01, which is equal to 2,000. In other words, our profit will be maximized when we sell 2,000 units. Now, based on the value of Q that we have, we can find the value of P. How? Just plug in that value of Q into our demand curve, right? So we can find P is equal to 30 minus 0.005 into 2000, which is equal to 30 minus 0.005 into 2000 gives us 10. So P becomes 20. So our profit will be maximized where Q is 2000 and where P is 20. Okay. Now oftentimes they'll just ask you for this. For the optimal production plan in the exam, you'll stop here. And say the profit is maximized where P is equal to 20 and Q is 2000, where sell 2000 units at a price of $20. But they might sometimes ask, like they did in this case, for the maximum profit under this situation, in which case we'll have our final step, finding the maximum profit, which is a straightforward calculation. First, we'll find the total revenue. Total revenue, as we've seen before, is equal to the price per unit, P, times the quantity per unit, Q. P we know is 20 and Q we know is 2000. So 20 into 2000 gives us $40,000 revenue. Okay. Then we have our total variable cost, which again, we know that the variable cost per unit MC is 10 and we're producing 2000 units. So this becomes 10, basically MC into Q, 10 into 2000, which is equal to 20,000. And this is the cost. So let's just put a negative sign here and a negative sign here. And that gives us our total contribution, which is equal to 40,000 minus 20,000, which is 20,000. And sometimes they'll just ask you for maximum contribution, in which case you'll stop here. But if they ask for maximum profit, we need one last part of the equation, which is the fixed cost. And we can get that data from our question above, where it says the total fixed cost is expected to be 12,000, right? So let's go back down. Okay. So total fixed cost is going to be 12,000. That means the maximum profit we can earn in this case is going to be 20 minus 12,000, $8,000. Okay, so let's break it down. Whenever there's a profit maximization calculation, there's 7 intuitive steps. Remember, we're ultimately trying to get to the maximum profit based on the equation MR is equal to MC. To get to MR is equal to MC, we need to find MR. To find MR, we need to find the demand curve. To find the demand curve, we need to find A and B, right? So the first step will always be find B for the demand curve, the slope of the demand curve, change in price over change in quantity demanded. Based on that, find the value of A and you have your demand curve. Given your demand curve, you have your equation for marginal revenue, which is based on A minus 2BQ. Set the marginal revenue equal to the marginal cost, which will be your variable cost. Sometimes they'll ask you to do a calculation for the variable cost. You can do that quite simply. And then you set MR is equal to MC to find the maximum quantity, the quantity at which profit is maximized. Once you find Q, the quantity at which the profit is maximized, you plug that into your demand curve equation to find P, the price at which profit is maximized. Once you have P and Q, you can then find the maximum profit by multiplying P and Q together to get the total revenue, multiplying Q with the marginal cost per unit to get the variable cost, taking the fixed cost from the question and getting your maximum profit. And just to reiterate, don't try memorizing these steps, right? Just think intuitively. You're trying to calculate the maximum profit. To find the maximum profit, you need to have the equation MR is equal to MC. For that, you need MR and you need MC. MC, you'll calculate the total variable cost per unit. MR, you'll need the equation A minus 2BQ, which is similar to the equation for the demand curve A minus BQ. So you need to find the demand curve. To find the demand curve, you need to find B and you need to find A. So those are your steps. Find B, find A to find the demand curve. Based on the demand curve, find the marginal revenue. Put that equal to the marginal cost. Find the quantity and price at which profit is maximized, and based on that, find the maximum profit.